Benjamin Graham was a smart guy. He knew how to learn from mistakes and was able to make unprecedented capital appreciation in the stock market. He was one of the top 1% of successful long-term investors, and his capital appreciation was 20% or more over an incredible 21 years. The average of the S&P 500 benchmark over that time was 12.2%, which Graham beat by less than 8%. Can you even imagine how much you would have made on $1 million over 21 years if you had appreciated it by 20% per year? You'd get to a whopping $64,417,000. The amount is with dividends reinvested. The magic of compound interest is incredible. Benjamin Graham is considered the founder of value investing, an approach where investors select stocks based on the assumption that the intrinsic value of a given title is significantly higher than its market price. This approach can be called thrift. But for Graham, it is primarily a conservative strategy based on his life story. His strategy is relatively simple and unobtrusive, but it has proven to be very successful. This is evident not only in Graham's own results, but especially in the results of his students. The results of Graham's strategy yielded an annualized return of plus 16% excluding dividends. Graham had 20 stocks in his portfolio that, without factoring in dividend reinvestment, handily beat the broad S&P 500 index, which had an annualized return of about 4%. This is just confirmation that value investing still has a place in the long-term investor's arsenal today. And now let's take a look at the parameters of stock selection according to Graham. Quality rating, earnings and dividend S&P rating greater than B. When picking stocks, you don't need the best quality companies. Average or better ones can still have high value. Look at the S&P earnings and dividend rating. Companies rated B or higher are safe choices. Historical track record and growth size matter. High-rated companies are more valuable. Financial leverage, total debt to current assets less than 1.1. When it comes to financial leverage, it's advisable to avoid companies burdened with significantly higher debt than their current assets. Opting for companies with low debt ensures their sustainability, as they won't have to liquidate fixed assets to repay debts, particularly during unstable times. Graham suggests selecting companies whose debt does not exceed 110% of net current assets for industrial companies. Companies' liquidity, current asset, current liabilities greater than 1.5. Regarding a company's liquidity, its capacity to fulfill financial obligations is indicated by the current ratio, which is calculated as the ratio of current assets to liabilities. Value investing suggests choosing a company with current assets that are at least 1.5 times its current liabilities. This ratio serves as an indicator of the company's ability to settle short-term debts. Earnings growth. Positive earnings growth for the last 5 years. In relation to positive earnings growth, Graham's advice is straightforward. Choose companies that demonstrate a consistent increase in earnings per share. Assess the company's earnings track record over the past 5 years. Companies that have shown consistent earnings growth without any deficits are considered a safer option. By following this principle, you reduce your risk by investing in the most secure companies within a specific industrial sector. Price to earnings ratio, PE ratio less than equals 9. According to Graham, when investing in a company, consider its cumulative growth over recent years. Earnings per share (EPS) reflects the company's profitability, and the PE ratio compares EPS to the company's share price. The key is to choose companies with a PE ratio of 9 or lower. Companies with low PE ratios compared to EPS are often undervalued, suggesting potential value appreciation. This criterion doesn't apply to high-growth companies, and PE ratios vary across sectors or industries. Therefore, always compare the company's PE ratio with its competitors before making a decision. Price to book value ratio, PBV, less than 1.2. Look for companies with a PBV ratio below 1.2. PBV ratios are determined by dividing the current share price by the latest book value per share. Book value serves as a reliable indicator of a company's intrinsic worth. Investing in stocks that are trading at or below the book value aligns with the principles of value investing. Dividends. Dividend yield greater than zero. Investing in dividend-paying companies is a simple and logical principle advocated by both Graham and Buffett. Dividends provide a means to generate passive income. Between 2021 and 2023, many retail investors have made irreversible errors by blindly following trends and other investors without conducting their own due diligence. Value investing inherently carries lower risk, as it involves a more informed approach to investment. Introducing Benjamin Graham, a modest investor. Graham lived in the years 1894 to 1976 and came from a family that originally possessed considerable wealth. However, the situation changed when Graham was 9 years old, as his father died and his mother was unable to run a successful business like her husband. She invested the family capital in stocks shortly before the panic of 1907, causing long-term financial difficulties for the entire family. This experience created a firm belief in Graham that capital preservation was the most important investment criterion in his career. After graduation, Graham began working on Wall Street for Neuberger, Henderson and Lowe. He gradually worked his way up from being a person who wrote odds on a blackboard to a trader. In 1925, he was said to be earning $500,000, a considerable sum at the time. Then, in 1926, he went into business with a partner, Jerome Newman. However, their business met with misfortune in 1929 when a business failed and the company suffered large losses. Graham and Newman worked for 5 years without pay to recoup these losses. This was accomplished much faster than the overall market, which took 25 years to recover. Since then, Graham and Newman have never caused losses to their clients. In addition to his career on Wall Street, Graham also became a professor at Columbia University. He taught a successful course there on investing. He wrote the important book Security Analysis in 1934 and The Intelligent Investor in 1949. The Intelligent Investor became a classic and is still the most read book on investing today. Graham's The Intelligent Investor focuses on character traits rather than pure intelligence. According to him, you don't have to have the brilliant brain of a scientist to be a successful investor. The key is to turn off emotions, maintain discipline, have a long-term vision and believe in a successful investment strategy. Graham was also a mentor to Warren Buffett, the world's most famous value investor. Both took a very responsible approach to buying stocks. Both shared the view that the stock market, especially in the short term, is not efficient. Short-term fluctuations in stock prices are just irrelevant noise that does not need to be paid attention to. Buffett has even said that the stock market as such does not exist. On the contrary, in the long run, the share price is always linked to the real value of the company. Investing is therefore relatively simple. One must do thorough research and determine the value of the company. If this value is higher than the market price, which Graham calls the margin of safety, then the investment is attractive. After that, one has to persevere and be patient because the true value will sooner or later be reflected in the share price. Of course, it is important to keep checking whether the fundamental value of the company has changed. Graham stresses that this approach provides a margin of safety and reduces risk. Graham also preferred diversification and avoided technology stocks. If a share price is well below its intrinsic value, then there is a little likelihood that it will fall further, even if the company's performance does not meet expectations. This is how Graham's philosophy influenced Buffett, who became one of the world's most successful value investors. Both of these great investors emphasize thorough research, patience and fidelity to their strategies as key factors for long-term market success. Thank you so much for watching to the end of the video. And it's clear that you are interested in value investing. Great, because the entire Invest with Jiri channel is focused on value investing. That's all for today. If you also pick stocks based on parameters, share it in the comments. I look forward to seeing you next time. Have fun and invest wisely.